Hey guys, welcome back. So in this episode, I'm going to be breaking down FSLY, which just reported its earnings yesterday, and the stock's down over 26% as of this morning. Now the main reasons why FSLY is down so much is because they're seeing increasing net losses, their Q2 forward guidance was much lower than the analyst expectations, as well as their CFO recently departed. So in this episode, I'm first going to be breaking down what FSLY is all about, going over their most recent earnings, and talking about whether or not FSLY could be a good stock to buy at this moment. To put it simply, FSLY provides developers with a secure and programmable edge cloud platform. In May 2019, they IPO'd with revenues around $145 million and seeing a 38% year-on-year revenue growth. As of today, they're seeing around $291 million in total revenue and seeing around 45% year-on-year revenue growth. The dollar-based net expansion rate is up from 132% to 143%, and they're seeing impressive annual revenue retention rate at 99%. Now, FSLY sits at the convergence of this digital transformation that we're seeing due to the code. Now, FSLY sits at the convergence of this digital transformation that we're witnessing. 75 of the applications will be built and not bought, and the software era is empowering developers to build new architecture and to drive operational efficiencies. 75% of the data will be created and processed at the network edge by 2022, and 90% of the companies will be multi-cloud by the end of 2021. Now, it'll be helpful for us to understand the history of web architecture and how edge cloud extends the developer control. Traditionally, with legacy systems, servers feed right into the network, and in this network, it goes through a certain set of processes and protocols that feed into the edge router. And this edge router feeds right into the CDN, or the edge POP, or the points of presence. Now, these CDN POPs are strategically located data centers responsible for communicating with users in their geographic vicinity. Their main function is to reduce round-trip time by bringing content closer to the website visitor. From here, it goes right to the user. But with the edge cloud, it starts with the server. However, it feeds right into the edge cloud, bypassing all the necessary steps within the network and feeding it right into this distributed computing paradigm that brings computation and data storage much closer to the location where it needs to be to improve response times and to save bandwidth. Now, FSLY has a global network with over 56 markets, and their focus is on developer first by being programmable, easy to use, and having a usage-based model. Now, web apps and APIs, or application programming interfaces, are all compatible with FSLY's edge cloud platform to be able to deliver, secure, and compute. Security will accelerate edge computing adoption, as safely and easily integrating new technology at the edge allows for acceleration in adoption of edge computing. And this is a virtuous cycle that continues to build on top of itself. Now, the key differentiators of FSLY is that it has a programmable edge, a software-defined modern network, safety in depth, and customer empowerment philosophy. Their mission is empowering developers with a secure and programmable edge cloud platform. So it's important to also look at the existing offerings in the current market. Now, there's legacy CDNs, centralized clouds, small business-focused CDNs, and core network and application security. Now, for legacy CDNs, one that you're probably familiar with is Akamai. However, FSLY believes that customers choose them over Akamai due to visibility and agility, cost efficiency, a modern developer-friendly architecture, and better performance. Now, they're also going up the likes of centralized clouds, such as the big players like AWS, Microsoft Azure, and Google Cloud. Now, FSLY has instant scaling, it's cloud agnostic. Now, a company that you're all probably familiar with within the CDN space is Cloudflare. And FSLY believes it's differentiated due to enterprise-grade features and programmability, as well as better performance. Now, FSLY is a B2B business, and their enterprise customers are helping drive their growth. They're seeing a steady increase in the number of enterprise customers, as in 2018 they had around 227, 2019 they saw 288, and in 2020 they saw 324. And every year, their average spend per customer, as well as the percentage of lifetime revenue, are all increasing. They believe they're also expanding their customer usage, as they're really focusing on their customer revenue expansion and being a leading online payments company. On year one, they focus on initial deployment, where they implement FSLY for origin offload cloud optimization, and as a redundant solution for the provider. In the second year, they focus on digital transformation, where they move application logic to the edge and then develop DevOps, or development operations, and digitally transform their workflows with Fastly's real-time control and insights. And in the third year, they focus on expanding the edge compute and security. This is an opportunity to build applications at edge to improve digital experiences for the customers and desire integrated security. They boost their customer usage and spend over time by offering increasingly valuable products and services. Now, in the opening highlights, we highlighted that they're seeing very strong customer loyalty and retention metrics. Their dollar-based net retention rate in 2019 was 136%. However, in 2020, it's up 143%, which means that the current customers, they're upselling them by about 43%. And of course, we couldn't forget about their annual revenue retention rate, which is 99% for the past 3 years, which is very impressive to see. So with that, let's dive more into their financials. Now, the market opportunity for Fastly is pretty large. In 2022, they're expecting their total addressable market to be around $36 billion, with $18.6 billion being app services and security at the edge, and $17.5 billion being CDN and streaming. Now, they're seeing about 36% compound annual growth rate for the past 3 years. However, if we look at it on a yearly chart, their growth rates are increasing from 38% from 2017 to 2018, then 39%, and then 45% from 2019 to 2020. What's great to see is that their gross margin percentage is also increasing year over year as well. In 2019, they were seeing around a 57% gross margin percentage. However, in 2020, that number rose to 61%. And this is due to the inherent network efficiency, which helps drive margin increase. As they acquire more customers, it helps drive in more volume, which gives more security insights, more connectivity, and more data in POPs. This translates to lower cost and higher quality. And this in turn helps drive up their value, which helps secure more customers in the future. So let's talk about what happened with this most recent quarterly results. So Fastly stock is down sharply after the downside guidance and the CFO transition. Fastly's down over 26% after the first quarter results met revenue estimates, reported a wider than expected loss, forecasted a downside Q2, and announced a CFO departure. For Q1, sales were up 35% to $85 million, and the loss per share was 12 cents, which was 1 cent worse than expected. Their CEO, Josh Bixby, wrote, "We delivered revenue of nearly $85 million, up 35% year over year, with our total customer count, excluding Signal Sciences, increasing to 2,207, which is up from 2,084 in Q4 of 2020. With enterprise customers increasing to 338, up from 324. In addition to generating new demand on the platform, we continue to execute on our land and expand strategy, with average enterprise customer spend increasing to $800,000, which is up from $782,000. What's also notable is that the CFO is going to be leaving as well, stepping down after 5 years on the job, but is going to remain with Fastly until a new replacement is found. Now, with the Q2 guidance, it fell flat of expectations as they targeted around 84 to 87 million in revenue, with the consensus being just shy of 92 million, and a loss per share of around 16 to 19 cents, with a consensus of a 8-cent loss. Now, I believe this is the main reason why Fastly is down so much, is because of this weak guidance. Targeting around 85 million with a consensus around 92 million on the top line, and projecting a wider net loss when the consensus was a decreasing net loss is a pretty weak sign of their expectations for the next quarter. As we've seen with other notable tech companies, although they've beaten earnings quite significantly, most stocks usually don't go up. Most stocks actually have sold off, even reporting after very good earnings. So with the growth stock seeing slowing revenue and increasing net losses, investors are clearly disappointed, and some are writing off Fastly's growth story moving forward. Now, the full year includes revenue of around 380 to 390 million, with a consensus being around 382 million, and a loss per share of around 35 to 44 cents versus the 37 loss consensus. So although the earnings report does give us a pretty good idea of how well the business is trending, it's important for me to take a deeper dive into their financial statements and really see the financial health of the business. So with the 3 months ended March 31st, 2020, the revenue was around $63 million. In 2021, this number rose to around $85 million. Now, the gross profit is pretty healthy, around 60%. However, their operating expenses is what's really hurting the bottom line. From 2020 to 2021, they're seeing almost twice as much operating expenses in both their research and development, sales and marketing, and general administrative. This has led their total OPEX from being $47 million, blooming to around $97 million in 2021. And of course, that hurts their bottom line, as in 2020, they saw a net loss of around $12 million. However, in 2021, this net loss is around $50 million. Now, as for their balance sheet, their current assets have gone up pretty significantly, as their cash and cash equivalents went up from around $63 million to around $948 million, with their total current assets sitting around $1.16 billion and having total current liabilities of just shy of $100 million. Their balance sheet looks very healthy, as the current ratio is around 11, which they have significantly much more cash to cover their current liabilities. Now, it's equally as important to look at the cash flow statement to get a better understanding of the actual cash that's transferred in and out of the business. Now, the clear standouts is that in 2021, they're seeing increasing losses in their net cash used in operating activities. Additionally, they're seeing an increasing loss in the cash provided by investing activities as well. Their total cash is up, which is great. However, the main reason is due to the issuance of convertible notes and net of issuance costs. So what does that mean with FSLY, and where's it going to go in the future? Well, after this huge dip in FSLY, it currently trades under a $5 billion market cap. And with 2020 sales around $290 million, that puts FSLY's price of sales currently around a 17. Although Q1 earnings missed estimates just by a little bit, the very low Q2 guidance was pretty surprising. I believe that the silver lining is that management expects unprecedented growth in the second half of 2021, although it's going to need to ramp up expenses in Q2 to achieve this. That means they're going to see increased net losses moving forward. Management raised fiscal 2021 revenue guidance, and importantly, I believe the long-term thesis still remains pretty intact. FSLY is still a very small company, emerging in a growing industry, and it's seeing early momentum with its compute at edge, which makes FSLY a linchpin between cloud and end users. I believe edge computing is a very large opportunity, and think investing now would be a good opportunity. The company is capturing most of the new game-changing digital-based applications within the market. Now, doing some quick technical analysis, we can see that there's been a huge head and shoulders which has formed over the past year. And after this Q1 earnings, FSLY has dipped from around $60 now to around $43. If you're a believer in FSLY's long-term growth story, I believe adding shares could be a good idea. However, for me personally, I would wait to around $35 where it has a lot more support. I do believe that there is going to be more downward selling pressure, as the main three reasons why FSLY is down will continue to weigh on FSLY's stock price until the next quarter. FSLY still has a very competitive edge cloud platform, which help enable customers to create great digital experiences. Their platform is designed to take advantage of the modern internet, to be programmable, and to support agile software development. And this trend will continue to persist over the next decade. However, at these prices, I would wait for some consolidation or for signs of upward momentum before adding into this position. With that, guys, thanks as always for sticking around. I hope you guys enjoyed this one. With that, I'll see you in the next episode, and let's go get that bag.